Well, thank you everybody for attending. And today's topic, as Janet mentioned, is property insurance. And it's centered around commercial property and the conditions, the terms, things I think people should be aware of. They're a part of every insurance contract, and they're the most common items I see become problematic for clients when they have a claim, there's an issue, and they're seeking insurance money. So my hope is you learn some tips, you learn some tricks, and ideally you get the most out of the current property insurance policies that you're buying or managing on behalf of others, and you just can buy the insurance better. And that is the outcome from this presentation. We're going to cover a variety of terms and conditions and some of the requirements the insurance companies place on the policy holders, and learn ways to navigate this, learn ways to ensure you're in compliance with what the insurance companies want you to be in compliance with. And again, the outcomes hopefully will be what you expect them to be. I think in general, before I start on the technical side of this, is people have a various level of like or strong dislike when it comes to the word insurance. And I reflect on that, and I think it really boils down to that whole kind of reputation of insurance, or that general perception of insurance for people that buy insurance or managing insurance claims, and maybe your own personal experience with your own insurance. I think it comes down to expectations. I think a lot of people that buy the insurance have a general expectation that if something happens, there should be some coverage available to them, that there's going to be money available, and that there's a lot of faith put in that transaction. And I think people get disappointed, and I think it really is finding out too late that insurance is a technical transaction, and insurance is a contract. I say to others when they ask what I do for a living, part of what I say, and is somewhat being facetious, but it's somewhat true as well, is I sell contracts, and I help manage those contracts with clients, because that's what insurance is. The insurance companies are selling you a contract. They call it a policy, but it's got terms and conditions on there. In exchange for money, they agree to this, and you agree to that. And the other thing is they throw all their terms like premium, that's just money. They throw in things like loss, it's just money. It really kind of clouds the fact that this is a legal transaction. And again, like I said a few times as the intro, my hope is you learn some of the nuances of these transactions and these contracts, and the expectations will be more in line with what you believe should be the outcome. And most often when people purchase these and there is an event and the insurance actually steps up, they're very satisfied with the entire process. And that's, again, what I hope that you gain from this today. Janet provided an intro for my background. I'm with Brown & Brown Insurance. We're a large independent agency. That means we have a variety of insurance companies that we go to place insurance coverage for. We manage claims for clients. In terms of real estate, and total values insured in my book of clients, it's exceeding $1 billion of values throughout the country. I have a higher concentration in the Midwest and the Detroit area, but throughout the country, we deal with claims, we learn, and we continue to adapt the insurance policies to what's going on in the environment. Like COVID's been an interesting change in relationship with insurance. Okay. Let's get started. I think the fundamental first step that property managers and building owners should look at when they're looking at a commercial property policy is what limit of insurance are they selecting, and is it the right limit? So a property insurance policy has a variety of different items it can cover. If you look in the left corner of the screen, you have obviously a building limit if you own the building. You have contents in there. You could have property of others that you're in charge of, that you're responsible for, business interruption, loss of rent if there's an issue. All these are covered in our property policy. Business interruption is getting a lot of scrutiny. a lot of headlines because of COVID and loss of business because of pandemic, governmental shutdown. As a side note, to date, U.S. there still really hasn't been a legal decision that mandates coverage. It's still been a non-covered event to this point. But you also have landscaping, trees, streetscape, water sewer systems, pavement. There's a lot of things to consider in a property policy. So the question I have for you is, how did you arrive at the limit that's on the property policy now? I hear from a variety of people, they look at the limit on the policy and they think of market value. So they say, the limit's 10 million. I could never sell it for that much. That was about a common response. Other people look at it and say it's not worth that, or I wouldn't rebuild it. And they look at the limit with a disagreement. Some people look at other items within the property policy, such as business, personal property, your contents, your furniture. A lot of CFOs, a lot of controllers will look at the book value. So they'll depreciate that total amount on their books and say, we only want to buy, action that happens to be a book value. So, the question I have for you, the first thing is, how are you arriving at the limit that you have in your policy? The second piece I'll have you look at is, this is how the insurance companies and how the insurance industry looks at property limits. These are the type of coverage options in terms of limit that they give you. One is replacement costs. That's probably the most common on a property policy. Is they agree to replace the building or replace the contents there within with just like they are in today's dollars. So they will, the fundamental piece of insurance is they're not going to make you better or worse than you were. They're going to put you back to how you were before the loss. So to take away and use an analogy that's outside of property, if I have a shirt with a bunch of holes in it and it's stolen, and I turn it into my insurance company, they're going to give me a shirt with holes in it. So, but with today's dollars, whatever it cost. So when you're looking at the limit on your building, if you have replacement costs, it is a cost to rebuild that today. So the question I have for you, is it enough? Same thing with your contents. Is it enough? So there's different tools you can use to figure out if that's the case, where you can gauge it objectively, and we'll talk about that later. The next common way insurance companies offer insurance limits on your policy is actual cash value. That's just like your car insurance, where if you have a 2015 vehicle and you're in an accident, you have collision coverage, they'll depreciate it for mileage, wear and tear, and then you get a value. They'll do the same thing with buildings. We see this on older buildings. We see this in areas with very tough crime scores, or there's a very tough geographic scope. That's often something they do. Or if somebody says, I'm not going to rebuild. I'm here. That's it. If I lose the building, I'm walking. Then you don't want to overinsure. You want to save some money. They do actual cash value. We see functional value on the upper right of the slide. That is where you agree with the insurance company. Listen, if something happens to this building, I'm not going to rebuild it exactly how it is. I just need it to function the same way. We see this with a lot of older buildings, early 1900s, just the construction type and the firewall design, and there's a lot of mezzanine spaces. People wouldn't do that these days. So we see functional value as an inexpensive way to cover buildings. And then sometimes we see stated amount. It's not common. It's harder to get than you think, but sometimes with real estate investments, or you buy it for the land, and there's a structure on there. Sometimes they listen, I just want 50 grand out of that thing, mainly for debris removal. So the first thing, when you're looking at the limits, how'd you come to it, and what does your property insurance policy say it's going to pay you? Is it going to pay for your property at replacement cost? Is it going to pay at actual cash value? And then really gauge, is that the right number for your policy and the property you're trying to cover? Next is an important condition and provision of every property insurance policy. If you're in charge of buildings and there's a property insurance policy behind them, it has a co-insurance provision in it. 100% of commercial property policies have a co-insurance provision inside of it. And you may know this term from your health insurance, or copay, and that's what it means. And a co-insurance provision is a mechanism for the insurance companies to make sure people are not underinsuring the values of their building. So on the grand concept of this, the insurance companies need their clients to purchase the right amount of insurance because of the actuarial statistics behind this, how they, retain some of the losses and claims they're going to pay financially. They buy insurance for certain levels too, outside of what they're going to retain, just like you and I buy insurance. So, there's a whole thing about underinsurance, and it's underfunded, and then the whole system could fall apart financially if people are not buying the right limits. And so they put this provision in the policy, and in every property policy, co-insurance provision is unambiguous. It's there. You'll see examples in it. It's almost 2 pages of that contract explaining to you what a co-insurance provision is and how they're going to apply it. So let's talk about what it is. On the right-hand side, I took an excerpt from an example in the property policy of one of my clients. And the simple formula is what you carried over what it was required. So it's did over should. What did you carry? What should you have carried? And the should is calculated after a loss. So the example I have on the left, it coincides with what's in the policy. We purchased $40,000 for the building limit. Okay. There's a deductible. The policy is at an 80% co-insurance. So just as a note, you'll be subject to, as a policyholder, you'll be subject to 80, 90, or 100% co-insurance, and it has to do with the limit you're buying. Let's say there's a $10,000 claim to the building. We submit it to the company, but so then they say, all right, their adjuster involved, and they say, okay, there's damage to the building. It's 10 grand of damage. Let's look at this building. You should, okay, it's this many square feet. It's this type of material. The right replacement cost for this was $100,000. So that's your should. So the insurance company gives you what you should have carried or purchased for the building. So in this example, did over should, as you see in the highlight. So I had 40. I should have carried 100, but 80% is, so you're at the 80% co-insurance, like you should have carried at least 80% of the replacement cost. In this case, it would have been 80 grand because that's 80% of 100,000. So we carried 40. We should have carried at least 80. The loss was $10,000. We only get 5 grand less your deductible. So that's what this co-insurance provision is, a penalty for not carrying enough insurance applied at the time of a claim. So I see this as one of the most common issues in a property claim, is that people fall into a co-insurance penalty and they have to share in the loss. So, because on the surface, I had a $40,000 limit. It was a $10,000 claim. Give me my $10,000 less my deductible. And the insurance company says, no. You underinsured this. You have to pay. There's a penalty for you underinsuring this. So again, this is anytime there's a claim, the insurance company is going to do this calculation after the fact. So here's another provision. I pulled this from a proposal. We legally have to show this to them. It's in the policy, meaning to the clients that are buying it, because it is so problematic. It's been litigated. The reason there's a lot of space and pages on the contract, the insurance policy, is because the insurance company is giving you every chance to understand what it is. So the takeaway is this: look at your property policies that you're responsible for, you're purchasing. What does your co-insurance provision say? And then look at the limits. And then, maybe talk to the agent or talk to however you arrived at these things or others that were involved, and try to understand if we're going to be in a penalty situations if we have a claim. So whether it's a total loss or a partial loss, the penalty will come into play if we're underinsured. Keep in mind, this can be for business personal property. This could be for building. This could be for business interruption. It could be for property of others. Everything on the property policy, there's this penalty lurking there, or this possible penalty if you don't have the right limit. On the screen next, this is an actual claim I went through with one of my clients. Yeah, we did on August 5th. This is the insurance company's replacement cost estimator. So just a minute ago, I said, make sure you have the right limit. You can ask your insurance company or your agent to give you your replacement cost estimator. So this is what the insurance companies run. Is they put in the material of the building, the size, the year, some of the other characteristics of it, and then they spit out this cost per square foot construction. So we had a client that had some wind damage to a roof, 2 locations. You know, it's an older Detroit building, so it's actually 2 separate properties, but it looks like one. And so they ran the co-insurance provision on it. And this is the cost for building 1 was $1,749,078, $139 a foot. And the building 2, adjacent to it, was $1,652,650. Now there's a tip that we have on there where co-insurance really didn't apply. There's a trick later to get rid of co-insurance. We had this on there, but they run this anyways. And they attempt to find ways to utilize this. And I'll talk about where else they utilize this if they can't apply it in a claim. So when I asked you about your limit, I often see people have very round numbers for their buildings and very round numbers for their business personal property. 10,500,000 for a building, 4 million for business personal property, $1 million for business interruption. I caution against that. As you can see from this replacement cost estimator, it's going to be very difficult to land at a round number. So if you're looking at your policies, you're looking at co-insurance provisions, you're looking at your limits, if they're round numbers, I would ask you to take a second look at that, excuse me. Because chances are, if you're subject to a co-insurance provision, you're going to run into a situation where you're not going to be able to meet that threshold, and you could be in a penalty and paying the loss. I bet you everyone's having fun. Next is business interruption. One of the most difficult claims processes there is business interruption claim process. So because it's a difficult claims process, the more work you put in up front, the better the outcome's going to be. And then again, that expectation, when people are disappointed and it doesn't meet expectations, it's a frustrating experience. It's frustrating for people on my side that's helping adjudicate and manage the claim process. But it's most frustrating for those that buy the insurance, pay the money, and rely on it to help them out. So if it's a real estate risk, good news here is business interruption is easier to pay. And if that means if you're just leasing out space and you have tenants, your rent roll, you can't occupy it because of covered claim, it's a pretty easy process. But the question is there a co-insurance provision? Did you buy the right limit? And that's, again, where that can lurk into some disappointment where you don't get the full amount of claim dollars you should. So business interruption really is, it's your net income. I tell people to use EBITDA plus your normal rate of operating expenses, including payroll. So if you're in a building, you're operating a traditional manufacturing business or a retail business or a wholesale business, whatever, distributor, and a tornado knocks out your building, people can't work for a little while. Tight employment market, you don't want to lose employees. The insurance will pay your payroll because you can't operate. You don't have revenue coming in because the building's gone. So those are things that are part of business interruption. When you buy the limit, you can include rental value in your business interruption, so it can pay for your. So if you're a real estate manager, you have your own office and operations, and then you're managing for others, right? You may have buildings you own where you're getting rent revenue from the tenants. So do you want to include rental value in your own business interruption? Do you not? Sometimes people buy a rental value only and say, listen, we can work remotely, especially with the transition over last year. The continuity of businesses is a lot stronger than it used to be. Some people buy a rental value only. The reason you would do different values is cheaper. The cost of the insurance is less. And rental value could be a couple different things. It could be buildings, but it also could be a space. Maybe you sublease the space, and it's all defined in the policy. The next thing to consider in business interruption also pays for extra expense. So I'm circling my cursor on extra expense. These are new expenses that are as a result of the event that occurred. So they're expenses you would not have otherwise incurred if this tornado didn't knock your building down. So you could lease a space, you could have to be paying overtime, you could be paying, other costs to try to get up and running. Internet used to be a cost, it's not so much anymore, but there's you might still have to pay your utilities. You may still have to pay your debt. You may still have to pay other expenses. Taxes don't go away just because your building's destroyed. So you want to contemplate all these things and extra expenses when you're choosing your limit. There's worksheets that the insurance companies give you. They're not fun to do. They're just Excels that take you gross to net, get you to EBITDA, have you can contemplate extra expense. No one likes doing them. I don't like doing them, but you have to do one to get a claim. So you have to do a proof of loss. So if you want to get business interruption, you're going to have to do it anyways. So, I really encourage people, do it up front, do it once, and then, every year you do a renewal, you got the sheet from last year and it becomes pretty easy. All right, business interruption. This is a declaration page on the right. And there's a couple different ways business interruption is covered and paid out in your policy. You can get a limit of insurance, or you can get actual loss sustained. If you have a dollar limit, that's the business interruption will pay just like a property policy, like a property aspect of the policy, which like a building or contents. Business interruption limit, you have $1 million. It will pay until that $1 million is exhausted. You could have a co-insurance penalty. You see it highlighted here. It requires you, if you pick $1 million and you underinsured, they will not pay you that full $1 million. They're going to deduct, as we saw earlier. The same formula is going to be used for business interruption as it would be for building. The only time period for this is the only deductible is time period. So there's a delay in time is how they would apply a deductible. If you see actual loss sustained on your property policy, so you'll see it on a deck page, you have limit, you might see ALS or actual loss sustained. That means there is no limit. They will pay you whatever your lost revenue and extra expenses are. It could be, this is a figurative speech, but it could technically be $100 million. Say your extra expenses were through the roof for some reason. There is no limit on what they'll pay. The only limit is the time period. So it's only 12 months if you have actual loss sustained. So some people think, that's plenty of time. I've been through multiple situations where we are 15, 16, 17 months into a property loss to a building, and we're still not back up. And a variety of things happen. A tenant issue, tenants got their own insurance problems, or they couldn't make up their mind. Some tenants have left, someone died in one situation. Sometimes if there's a fire, inspections and some of the investigation that has to happen. If anybody's been through a fire situation, 100 people come from 100 different places to get involved in that thing. So it just delays a lot of things. And obviously disruptions to supplies like we've seen in the marketplace over the last 6 months, that delays construction, that delays cost. So 12 months sometimes isn't enough time. It might seem like it up front, but it may not be. Two major traps on a business interruption. So take notes here. If you see a monthly limit of indemnity, it says fraction here, don't go to sleep tonight till you get that off your policy. This is such an arbitrary, terrible limitation that's on business interruption policy. What it means is, we used this $1 million earlier. If you have $1 million limit here, so let's say we don't have co-insurance. I'll tell you in the next slide how to get rid of co-insurance. But you have a 1/3 monthly limit of indemnity. You'll see 1/3, 1/4, 1/5, 1/6. Those are the fractions of limitation that they put on policies. So if I have $1 million loss in my month, and I have a business interruption of $1 million, and I lost $1 million this month, and I have a 1/3 limit of indemnity, they will only pay me $333,000. I have $1 million. My loss was $1 million. I don't have co-insurance, but they put a monthly limit of indemnity. So it's like, no, we're only going to pay you 1/3. I can't think of a reason why a policyholder would want that. Maybe there's an exception I'm not thinking about. It's only advantageous to the insurance companies. So they limit what they'll pay you. And why would they do that? It's save them money. It's a way for them to know their expense, cap out the max they would have to spend. And how you would see this is your business interruption cost, the premium would be cheaper. So Over time, a lot of the transactions, a lot of the meetings with clients is that you have a lot more renewals than you have a lot more than claims. I mean, it's, really 10 to 1. And there's a lot of pressure on price, and then nothing's happened, and they want the price to go down. So the insurance companies will offer this as a cheaper way to insure this stuff, but at a time of claim, it's detrimental. They also can put a maximum period of indemnity on your business interruption. That means they will only pay you for 90 days. Again, why would a business want that? I can see that if a business is got a very strong continuity plan. I have some clients that are single source suppliers to some major corporations. And part of their requirement to be a single source supplier is they have to have a full continuity plan. I mean, a location leased, utilities already set up. So they have to be up and operational within a certain period of time. So you may want to put a maximum length just to keep the cost down, but you don't want a limitation those first few months. The biggest dollar amounts, the biggest losses, the biggest set of expenses is the first 30 days of a claim. You don't want this monthly limit of indemnity on there. Okay. I've been teasing this a little bit. How do you get rid of co-insurance? Get agreed value. So in your property policy, in the contract, it goes through what the coverages are, what the exclusions are, what's available to you. They have to do that by law. By law, the policies have to be at an 8th grade reading level from a technical standpoint. They cannot be. They used to be a lot more legalese at a much higher, comprehension level. That's been litigated. It's been, pushed to be simplified. They still are very confusing to read. So, not that they're not easy by any means, but the language is supposed to be clear enough where it passes that test. In every policy, you'll see optional coverages. You see over here my cursor, agreed value. This additional condition, co-insurance, does not apply to covered property in which this optional coverage applies. So the cost for agreed value is 0. All you have to do is sign a statement of value, say this is the property limits that we're buying, this is all we want. The insurance company accepts that. They will not apply co-insurance at a time of a claim. So if you have a building, you want agreed value on building, you want it on business personal property, you want it on business interruption, you want it on property of others, you want it on outdoor property, fences, signs. You don't want co-insurance, and you can get rid of it for $0. You need agreed value on your policy. You need it every year. Every year you got to re-sign up for it. The next trick or tip to make sure you get the most out of this property policy is to have blanket limits. And blanket term isn't as descriptive as I like it. I would call it bucket. And you're taking all the limits I've been talking about. You put building into a bucket, contents into a bucket, business interruption, it's got its own limit, but property of others in a bucket, outdoor property in a bucket. And then as that fills up, you have a big limit of insurance. And that gives you hedge on valuation. So people that have a lot of inventory and it changes up and down, right during this whole last year, some people have been buying a lot because of cost and holding on to inventory. So there's been fluctuations. So you're never going to be accurate on business personal properties. So how do you hedge against that valuation error? Combine building, combine business personal property. Now you got a bigger limit. So, and if you have agreed value, you don't have a co-insurance. So there's money there, and it's an easy claim. And that's when people are satisfied with the property policies, is when they have these 2 conditions on there and a claim happens. Most often we're in great shape. The limit works out, the traditional adjustment happens, but there's not an issue with the payout. I have 2 examples of how blanket works here. I'm just trying to illustrate the point. It's I'm not going to go through this and get real technical on it, but if you combine 2, if you have one location only here, you can combine building limit here. Let me go back. Sorry. Building limit of 900 grand. I'm down here. Business personal property of 450. So you're buying $1,350,000 combined. So a loss happens. You got a co-insurance penalty here. If you guys do it right, you won't have co-insurance. You don't have to worry about it, but that plays in this example here. But a blanket would pay $50,000 more than the schedule would by the way of combining the 2. Now, if you have multiple locations, that grows exponentially. And again, the valuation hedge continues to soften. It becomes a much easier selection of limit and claim process. So here are 3 stores. We have different values for each one: 100 grand, 200 grand, 150. We buy a blanket of 450. So we blanket these together. We put them all in one bucket. We got one limit, 450,000. So that means 450 paid at one location or all 3 if there's a claim. If there's a loss, we had the bucket. So it turns out location 2, we see right here is 200,000 for the store. That was the limit that we bought. Turns out it was 245,000 replaced that store. Because we bought a blanket limit of 450, we get the full 245. Even though the limit we chose was 200, because we had the blanket bucket of money, we get the full 245. If we had a schedule only, we'd be $45,000 short. So my takeaway here is make sure you have agreed value, make sure you have blanket limits. Watch out for the margin clause. If you do have blanket, it's one of the top 50 worst insurance endorsements in history on a property policy. Number 1 is coinsurance. So watch out for coinsurance. But the margin clause basically eliminates blanket. So again, these are more games the insurance companies play to limit their risk, but in return, you get a cheaper premium. So over time, you got pressure on price. Insurance companies change this terminology and conditions. You get the lower price, but then we have a very problematic claim situation, which we didn't intend. So a margin clause would take multiple locations. We had those 3 stores, and they would restrict on how much you can go above per limit. So the example that store 2 was 200,000. The loss was 245 there. If we had a margin clause on there of 10%, the max we could get for that location is 220 instead of 245. We don't want the margin clause on there. Get rid of it. I told you about the monthly limited indemnity, the example here, and then the co-insurance, which I call the Monday money quarterback. So, nothing's more frustrating and unpleasant than you have a loss, you got disruption to the business, and the insurance company comes in here, almighty, with people that all they do is adjust claims all day long, who are heartless. They look at it and say, "Oh, you didn't buy enough insurance. Too bad. We're going to penalize you." That's why you want to get rid of co-insurance. I have a deck page over here. So right here, we got summer values. We have multiple locations. We have blanket limit right here, right? Blanket building. It's all included. Everything looks good, right? Replacement costs. We don't have agreed value. So just because you have a blanket doesn't mean you'll get agreed value. You need both. Okay. You're going to hear terms, ITV, TIVs. ITV is an insurance company talking to property holders, and they're saying insurance to value. They have their own system of numbers saying how much insurance are you buying to the values, and they have a gauge. Is it enough? You often hear from the agency side total insurance values. So we're talking about what other values are we trying to buy insurance for? They sound similar, they mean similar things, but when you hear ITVs, that's the insurance company talking, and they want you to raise your limit. So you got to remember, there's 2 ways a property premium is calculated. By the total limit you're buying, the more insurance limit you buy, the more money it costs. The less money it costs. And then also the rate that they charge. So you give me a rate, I can tell you how much the building's going to cost, or contents are going to cost, or business interruption is going to cost. So insurance companies all go through this. They're going through this again now. And what they're trying to do is they'll come to us before renewal. You guys have probably been through this. We need to raise the limit of your building. The insurance to value is too low. You're not carrying enough. And the cynical view on that, and I share this cynical view, is they're trying to get more money. They want you to buy more limit. And often there's larger schedules involved. So it's not just one building that they want to go from $1 million to $1.1 million. It's typically a $100 million, $200 million schedule. They want you to buy another 10 million, another 20 million, which has got a lot of money behind it. The other part of it, the less cynical, probably the more puristic view, and I do believe there's some of the truth in this, is they don't want you to be underinsured. Nothing could be worse for anybody. It's a lose-lose-lose situation. Is if you buy insurance, you got agreed value, right? No co-insurance, you got a blanket limit, but it's not enough. And you're short. and everyone's disappointed. That was not the goal. The second, from their actuarial side, is they need to have the right amount of money flow in the system so it can withstand large losses. I'm not sympathetic to that. That's their business. They got to figure that out. But there is validity to that. So what do you do? Back to the beginning, we talked about limits. Request a replacement cost estimator, that's RCE. So you can talk to your agent, talk to your insurance company, say, give me a replacement cost estimator per my building. Okay. And it'll look like what I showed you earlier, cost per square foot, material, whatever. Review it. This is what they say. Do you agree with it? Do you disagree with it? And come to a limit on that. You can invite the insurance companies out and have them do an assessment, and they can tell you what they think the true cost to value is. They're going to do that at a time of loss anyways. They're coming out, they're doing these estimations. You might as well do it up front. The one thing I will caution you against is a real estate appraisal has nothing to do with the insurance limits. So I often get appraisals sent to me. It says, all right, this is what the limits we want. If you remember back to the earlier slides, is that replacement cost? No. Is that actual cash value? No. It could be functional cost, maybe. But there's a lot of characteristics that there's no insurance for land. There's a lot of things not covered in their insurance. So they're got to rebuild it back to how it is. They don't care about market value. So the real estate appraisals don't have any meaning when it comes to selecting limit. The last thing I'll say before I move on, we got a lot to cover, is other things to consider in a property policy. Underground pipes are not automatically covered. You can get it. I see sewer collapse in parking lots of locations. Those aren't covered unless you specifically get that endorsed on. You can. I see utility issues, trees and landscaping. There's very minimal coverage, and your homeowners too. There's really nothing down there. They'll clean up the trees. So, but you can buy it if that matters. So landscaping is expensive, streetscape is expensive, but you got to schedule it on. Fencings and signs also very limited unless you schedule it. So all these things should get your attention up front before a claim happens. Ordinance and law. Hang on one second here. Next. You'll see in the upper corner here, ordinance or law, you see the word endorsement. So this endorsement means it's a fancy word for change, just like policy is a fancy word for contract. This means it changes the policy. So what we have here is, I have an example over the right, and there's 3 or 4 different things you need to consider and make sure it's in your property policy when it comes to different situations that can occur with damage to the building. So for example, I have a 5-story apartment building that we just put the insurance in place for. It's 117,000 square feet. What if the building is only 51% damaged? There's a fire. You got smoke damage and water damage on 51% of it. And then, so we got, 70,000 square feet damaged. The other 70,000 square feet is I didn't do the math right. It was 55,000 square feet, excuse me. What if the local ordinance or the code says, well, because it's over 50% damaged, you got to tear down the whole thing? Do you expect the insurance company to pay for the whole thing? The answer is it won't unless you have this endorsement in the policy. So the insurance company says, listen, if it's damaged and it's covered, we'll pay for it. So think about it, only 51% of the building's damaged, they'll pay for the 51%. What about the other 49%? And the property the property owner and the policyholder is going to say, listen, I'm required to tear it down. I didn't cause this. So ordinance and law will be the insurance that triggers payment for the other 49%. So there's 3 sections of ordinance or law. One is coverage A. Coverage A is for the undamaged portion of the building. So the extra 49% that isn't damaged, coverage A gives you that. So what you want in your coverage A limit on your policy, so you're going to look at co-insurance when you get back, you're going to look at agreed value, you're going to look at your limits, you're going to look for ordinance and law. Coverage A should say up to building limit. So on this location I have here, it's a $16 million building. I have $16 million for ordinance and law coverage A. That's what you want on yours. The second component of ordinance and law, there's this if 2 of 3, is the demolition cost. So again, of that apartment building, 51% is damaged. Insurance company's going to pay for that. They're also going to, clean. They're going to help clean it up, right? It's destroyed. We're going to. That's part of the coverage. Well, what about the undamaged portion? So we just paid you the whole 16 million bucks. So you got coverage for your building. Now you want us to tear it down too? Okay, well, you need, there's extra insurance for that. That's what coverage B is. So you often see in an off-the-shelf policy that has one of these in here, coverage B is at $25,000. That's the minimum you see. Sometimes you see 50 grand. I would venture that's not enough money to tear down structure. So I would caution you, look at your limit on coverage B. Coverage B will tear down the undamaged section. The last part of ordinance and law is coverage C. Now, coverage C is increased cost of construction. So that's what I'm dragging my cursor over here. And this is increased costs to bring the building up to code, the current code. So this is very applicable in every claim where you don't have a full loss. So right now I have a client that has a bunch of hotels throughout the country. One hotel had a water issue on the 3rd floor of an 11-story hotel. A contractor came in and was doing some upgrades, and they messed up, and water was flowing. A lot of damage was sustained throughout. They couldn't rent the rooms, so because we got business interruption issues, we got content issues, we got building issues. One of the things damaged in there was the fire panel. So this building was built in 1984, and the fire panel that had sustained damage needed to be replaced. They didn't make this panel anymore. It's 2021. Well, we have to change the panel. Well, if you touch the fire panel, as many of you may already know, if you touch that, you got to bring it up to code. So the NFPA says, okay, if you replace one part of that fire system, the fire alarm, you got to replace the entire thing up to code. The whole thing's got to come up to code. You can't just change the panel. So it's an 11-story hotel. They needed to install more sprinkler heads. It's required now. They needed to install strobe lighting, extra exit signs. They needed to do fire watch while the system was taken down. The total cost to just get the fire suppression system in line with 2021 code was $832,000. We had $1.1 million in contents, building, and business interruption. We had another $832,000 in coverage C. So I've seen this on buildings, small buildings in different, Ann Arbor. I had one where they had a water burst claim, and Ann Arbor requires now that the piping can't be too close, so close to the outside wall, you got to move them all inside. So go back to your policies. What limit do you have for A for non-damaged building? What do you have for demolition? And what do you have for increased cost of code? ADA compliance, put in an elevator, you have to put fire suppression in, all the other things that could come up to get building up to code. There's insurance for it if you buy it right. Another thing to consider for the real estate side with rental, with those that are leasing out space, is if the building's got water damage. I've had this issue. They had water damage, they fix it, but now they got to bring it up to code. What about that lost revenue, lost rent? While it's being up for code, there's a special endorsement in here for business interruption that you need there, which is coverage D. Cap off, ordinance and law, undamaged, debris removal. I suggest at least 250, not 500. Increased cost at 500 or more. Depends on the type of property you're insuring. And then look at the time period for coverage D. Protective safeguards. Know that these in your policy. These are one of the most dangerous condition. So I call it a condition. There were insurance companies saying, we're going to give you credit, or we're only going to offer insurance for this type of building if you meet certain conditions. And they call them protective safeguards. So there's certain things that are going to protect the building. Fire suppression, if you got some hazardous material inside. Plastics gets a lot of scrutiny, chemicals, those type of things. If that's going on inside a building, they're going to want, or heavy welding, things like that are just flammable materials. Even dry cleaners, especially the ones with a lot of spontaneous combustion there. they're going to say, we'll only offer insurance if you have fire suppression in there. Or if it's in a tough area, you need to have an alarm system. You need to have it monitored. So they will give you the insurance, or they'll give you discounts for having these things, but it's conditional. If you don't maintain them and there's an issue, they will not cover you. And these things are very, very upsetting when they happen. I'll tell you about a personal example on one. So this is part of the protective safeguard. It says the following is added to exclusion. So exclusion means they're not going to cover. And it means if we will not pay for a loss if you fail to maintain or you knew of the suspension of that protective safeguard, whatever it is. If you can restore it within 48 hours, you're okay. So you had this implied grace period of 48 hours. So those people that have a lot of buildings, especially throughout the country, sometimes things happen. They have systems go down or there's issues. And if these safeguards are taken down and you don't tell the insurance company and there's a claim, there's a damage, they will not cover you. This has been litigated up the wazoo, and this is unambiguous, and you will lose that court case every time. So here's a real loss example. I had a client insuring a vacant building in Metro Detroit City. It's about 100,000 square feet. It was vacant for about 8 years. Trying to sell it, trying to lease it, trying to do different things. We secured the insurance. We had a replacement cost on it. We had agreed value, no co-insurance. And they had these protective safeguards on there that said, we'll do it if there's a burglar alarm. And there's it had to be central station. It had to be tied to a police station. We will not pay for damage or theft if you don't. You'd had to have a fire suppression system. That's what the P1 is. The other thing that they slipped in on a renewal that we didn't see. So for 7 years, we had P1, P2, P1, P2, P1, P2. We get a proposal, we look at it, policy check, no issues. We have a claim. The city calls and says, hey, water's pouring out your building. I mean, this is one of the worst water damage losses I've seen. A 70-inch main feed in broke. This building was about 44 years old. The main just broke. It was a holiday weekend, of course, and water's just gushing out for how many days. So we call the insurance company, set up a claim. The adjuster comes out, and the first thing I ask over here is they ask a question. They caught me off guard and said, what security firm what security service do you use? Can you give me their hourly logs? And that was the first question they asked. And what's that about? And they didn't really answer. And then we got a denial that said, you're required to have a security watch person make hourly rounds and record it while the building's not in operation. This was new. They added it in. It hadn't been there for 7 years straight. Never seen it before. Somehow it got slipped in our policy check. Didn't catch us. We're like, what the heck? They denied it. Well, we went back. It was a mistake. They shouldn't have put it in there. Do I consider that lucky? Yes. But the point of this example is they end up paying the claim. It's $2.5 million. The example is they denied it. If you don't follow the safeguards, they won't pay the claim. So know what your safeguards are. If you can, get rid of them. So they give you a discount sometimes for having these things. And I tell the clients, I don't want the discount. It comes with too many strings. So if you have protective safeguards, know what they are and make sure you're following them, or get rid of this safeguard altogether. Water damage. One of the most common claims that we have and we see is water. Water always wins. I'm sure you guys talk about that in your property management businesses. But insurance knows water always wins, and they got all kinds of guards against coverage on this. So a traditional water claim is excluded on the off-the-shelf policy that you don't have water damage coverage. So you have to get it as an enhancement. You have to buy up on it. The other thing that catches people a lot is this one down here, this continuous and repeated seepage or leakage of water. It's 14 days or more. Insurance companies will not pay for maintenance issues. So I just had this happen recently. We had a big freeze in February here in Michigan, and all of a sudden the part of a building, some of the bricks are coming off, and water froze, and now it's it expanded and now it contracted. We call it the claim. Did that happen over a 14-day period of time? Roof leaking issues, mold issues. If it's continuous, they're not going to pay for it. You can't buy it. So that's a maintenance thing. Just know that. Know your flood zones. So at the bottom, there's a link on FEMA. You can go to FEMA.gov and look at your flood zones. They generally go with X and A. Most of us would know. There's different versions of that. So you might hear on a news report, 500-year flood zone, 100-year flood zone. Know which one you're in. If water comes in from the outside, it's flood. I don't care how it got there. Another tip: if you do have a water loss, don't ever use the word flood, personal or commercial. If water gets in your basement, don't say my basement's flooded with water. If it gets into a building, don't say it's flooded. A lot of insurance companies, if you mention that, they will not come off that. They'll deny it unless you have flood coverage. So know what flood zone you're in. Typically, you're in one because you have to buy flood and it's expensive. But I will caution you, 20% of all flood losses every year are in zone X, which is a 100-year floodplain or 500-year. I mean, it's a 0.002% chance you'd have a flood, but 20% of the year, the last 8 years, it's happened. If you're in a flood zone X, it's cheap, so I would suggest you get it. I'm gonna make up time here so we can get through this. You can buy. I have a picture here, August 11, 2014. This is 696 I-75. I had multiple clients have rain issues. We got 6 inches of rain in 3 hours. Any rain coming in was flood. So if you're in an X, you're not in a flood zone, you can buy a flood for cheap. Buy it because of these events. Discharge from water sewers, you can get water back up. You buy it. It's not expensive. Get 250, get 500,000, get enough money, but there are conditions in it. You must keep it clean. Read the policy. So you can't just buy it and not maintain sub pumps and other things to help prevent water flow. Because if you don't keep it clean, they'll deny the claim. Here's a example of a property policy. Do you have flood? Do you have quake? This is a flood zone, NFIP deck page. So National Flood Insurance Program, FEMA. If you got to buy flood, you can only buy building the contents. You can't buy business interruption. You can only buy a certain limit. If you want to buy more of that coverage, you got to go above. Hey, Janet. One last provision here, and I'll open up for questions. It's vacancy provision. It's in every policy, just like co-insurance is, with shutdown, with work from home, with remote. This is a lurking issue. If a building is unoccupied, which means 31% technically, but more insurance companies go up to 70%. If it's unoccupied for 60 days consecutive or longer, they will not pay for 5 things. They won't pay for vandalism, sprinkler leakage of your fire suppression systems, glass breakage, water damage, theft, or attempted theft. Anything else it pays for, wind, fire, other car strikes, this type of thing, they'll pay it, but they'll reduce it by 15%. So if the buildings that you manage or you own are not occupied by at least 60%, and it's been 60 days, you need a vacancy permit in your policy. This allows you, this condition does not apply to locations. It allows the buildings to be vacant. It will not penalize you with the vacancy provision. I've reached my time. I see Janet, so I will open it up to questions.
Ryan, thank you so very much. What a great presentation. We appreciate it. This will be posted on the BOMA website under resources for future use. And we'll ask Brian if he'll also share the PowerPoint. Do I have any questions? I don't see anything in the chat.
That means I did a great job with all the details. So
You did a fantastic job. All right, then we look forward to seeing oops, I see one in a Q&A. Let's see. What is the most common mistake you see?
Co-insurance provision. Co-insurance mistake is the most common one I see. And the second one is ordinance and law. They don't have any coverage for the ordinance and law. BOMA has these resources. There's a ways to research your code for wherever your buildings are located. I have called city engineers in different townships and talked to them before when researching, especially older buildings and the uses and modifications that have happened. what are we required? What are the thresholds to tear down? But co-insurance, to answer your question, co-insurance is the most common issue, and it's the most frustrating because it's a penalty applied after a loss.
All right, thank you. We did have one other question and asking, will the link be available to participants? And yes, it will, hopefully within the week.
If people have questions on the PowerPoint, it has my contact. Feel free to email me or call me
Great.
about different situations that occur.
One other one, what % increase in premiums should we anticipate?
Property insurance is under some pressure right now on pricing. On average, we're seeing about 5% for commercial property throughout the Midwest. The coastal states and the tougher states that have had more extreme weather events or conditions are closer to 10%. The individual claim experience could augment against that. But on average, we're seeing 3 to 5%. And that's because the insurance companies, what they pay for insurance by reinsurance, those rates have gone up. About 10 insurance companies insure all major losses worldwide. And the last 5 years have been very active hurricanes. There's been some extreme weather events. There's been some wildfire events. And they've absorbed those losses. And this year is the big rate increases, and the insurance companies are passing those on. So it's about 3 to 5% we're seeing on commercial property.
Any other questions, folks? No? Well, then I wish you all a good day. Again, our thanks to Brian Filarski and Brown & Brown Detroit.
Thank you.
Have a great day, all.